All right, welcome to this explainer. Today we're diving into a complete due diligence overview of Sweetgreen, looking at it strictly from an investor's perspective. We've got this highly publicized, incredibly bullish Wall Street upgrade on one hand, and then, well, the hard realities of their latest financials on the other. It's honestly a fascinating case study in the classic battle of growth versus profitability.
Okay, let's take a quick look at our roadmap. We're going to cover the Wall Street upgrade, insider and institutional buying, the sweet growth transformation, innovation with wraps and automation, the financial reality, and finally, evaluating the risks. Let's get into it.
Starting off with Section 1, the Wall Street upgrade. So consider this staggering figure for a second. 44.7%. That's the massive potential upside implied by JP Morgan Chase right now. They recently upgraded Sweetgreen from a neutral to an overweight rating, slapping a $13 price target on the stock. And look, as an investor, when you see an upgrade with that much implied runway, it's an immediate signal to sit up and pay attention, right? But here's the catch. Wall Street is deeply, deeply divided on this one. If you contrast JP Morgan's bullish $13 target against the broader consensus, the picture changes entirely. According to MarketBeat, the consensus rating is just a hold with an average price target of only $7.98. You've even got major players like Goldman Sachs coming in with a sell rating and a $5.60 target. So you have to ask yourself, why such extreme polarization?
That brings us to Section 2, insider and institutional buying.
If we look at recent filings, we're seeing a really heavy volume of purchases from insiders and major funds. Just look at co-founder Nicholas Jamet, an insider, increasing his position by over 24%. And then you see these absolutely massive institutional moves. Marshall Wace upped their stake by a staggering 1,428%, right alongside huge multi-million share buys from Woodson Capital. Even Goldman Sachs bumped up their position. All these moves have pushed institutional ownership of the stock up to nearly 96%. So despite the mixed analyst ratings, conviction seems incredibly high among the real heavy hitters.
Moving on to Section 3, the sweet growth transformation.
So what's driving all that institutional buying? Well, a lot of it comes down to CEO Jonathan Neiman's 5-point sweet growth transformation plan. The whole idea here is to strengthen the company's fundamentals and really tighten up execution across their 280-plus restaurants. They are zeroing in on operational excellence, which basically means faster throughput and actually having the right ingredients available, along with menu innovation and what they're calling disciplined, profitable investment. They want scalable systems so that every single restaurant executes at a high level, not just their flagship locations. Now, the absolutely crucial point here is how leadership views the timeline of this turnaround. As CFO Jamie McConnell emphasized during the Q1 earnings call, executive management is laser-focused on rebuilding top-line momentum and improving those core restaurant-level economics. They openly acknowledge that this is going to take time. It's not an overnight fix, but the ultimate goal is to build a brand that is more consistent, profitable, and durable in the long run.
All right, Section 4. Innovation, wraps, and automation.
Let's talk about how this strategy looks on the ground, starting with menu innovation. The nationwide launch of wraps is acting as a major catalyst right now. During their testing phase across 70 different restaurants in markets like New York and LA, these wraps actually drove incremental traffic from both new and returning guests. And surprisingly, the CFO specifically noted this, it's yielding really favorable cost of goods sold. Why? Because of lower prep times and reduced food waste. Plus, maintaining a highly accessible entry price point starting at $10.45 is absolutely key for attracting more value-conscious customers. It's a really strategic move to capture a much wider audience. Beyond the menu, though, there's the operational tech. 33. That is the number of Sweetgreen restaurants now powered by their Infinite Kitchen technology as of Q1. Sweetgreen is leaning heavily into this automation to drive operational efficiency and push more volume through the lines. In fact, looking ahead to 2026, they expect about half of their 15 net new restaurant openings to feature these fully automated units. Which leads us right into Section 5, the financial reality. And here is where we need to ground ourselves, because the tension in their financials is stark. On one hand, you have this aggressive physical expansion, opening 35 new locations in 2025. But that sits right next to a really painful 7.9% drop in same-store sales. And if you dig into that negative metric, it was primarily driven by a 10.4% decrease in foot traffic. So essentially, they are aggressively expanding their physical footprint while their existing established stores are actually seeing fewer guests. It's a tough dynamic that reflects a much more selective consumer environment. And this financial friction has heavily impacted Sweetgreen's historical stock volatility. When you map their cumulative return against the broader restaurant indices, those wild swings downward show exactly how the market historically punishes those classic growth versus profitability growing pains. The latest data just continued to pile on this pressure. Q1 of fiscal 2026 saw a 12.8% comparable sales drop and an $8.1 million operating loss. On top of that, they are absorbing millions in restructuring charges, which includes severance packages for reduction in force and lease costs for vacated office space. All of this friction has forced management to issue pretty conservative negative guidance. They're now expecting same-store sales to decline anywhere between 2% and 4% for the remainder of the year. Finally, let's wrap up with Section 6, evaluating the risks. First up is a massive structural risk, their automation dependency. Remember that infinite kitchen tech? Well, selling it off to the Wonder Group in late 2025 created a really complex transition. Basically, Sweetgreen is now entirely dependent on a third party, Wonder, for the supply, commissioning, maintenance, and support of their core automation strategy. If Wonder experiences disruptions, if they decide to raise their fees, or worse, license this exact tech out to competitors, well, Sweetgreen's operational edge could be significantly threatened. Furthermore, they are facing mounting macroeconomic pressures across the board. You've got California's recent mandate hiking the minimum wage up to $20 an hour for restaurant chains. You've got increased supply chain tariffs, which, by the way, already drove the cost of those infinite kitchen units up by about 5% in 2025, not to mention the impact on food packaging. Add in higher protein costs from increasing their chicken and tofu portions, and you can see some very real, very heavy pressure weighing down on their profit margins. So, as an investor, you've got to weigh these two very distinct competing narratives. We're going to leave you with this final thought to chew on. Can Sweetgreen's transformation plan, powered by these new wrap innovations and kitchen automation, successfully bridge the gap between Wall Street's highest hopes and the company's current, on-the-ground financial realities? Thanks for tuning into this explainer,